The FOMC did not change rates, and Federal Reserve Chair Jerome Powell reiterated that the Fed officials are not in any hurry to adjust interest rates. The S&P was slightly higher. The NASDAQ probably would be too if not for Alphabet. We're going to talk about those today on Open Interest. Hello, everybody, and welcome to today's From Mr. Rogers' Neighborhood. I've got this sweater going. We're going to talk a little bit about the land of make-believe on Mr. Rogers' Neighborhood, because I think the big story today amongst single stocks was Alphabet. I have a chart up on my screen, actually, of it. The stock was down almost $12 today. It was down more than that, certainly at one point. So we've had a fairly precipitous decline now of about 25% since the all-time highs that we saw in March, and we're now actually considerably lower than we were at the start of the year. This was a name that I actually had liked because I felt like it was getting very cheap on valuation, that people have had a tendency to underestimate the business. Oftentimes you would see that they came out with some positive surprises on the fundamental front when their quarterly earnings were released. But the news today really was coming out of Apple. And one of the things that was said was that because people are now using AI, really the large language models, ChatGPT, Grok, etc., for search instead of Google, that Apple's actually thinking about embedding those types of applications more closely into Safari. So that would be essentially breaking with that long-term allegiance. And of course, this is an important development for Alphabet if true, because while they have a lot of other businesses, so there's Google Cloud, which is obviously a very important portion of their business, it is really the search, it's the advertising related to search that represents the bulk of the company's resources. Now, I'm not going to change from this tile that I'm on right now because I'm thinking there's been a lot of damage done. The company's going to be reporting right now. The estimate is for July 23rd. So I was actually looking out to July regular way expiration, and I was thinking, we've seen such a big bump up in implied volatility, and so much damage has been done that maybe selling a strangle, such as and this is mapped out, so I just wanted to have these break-evens here. This would be I wonder if I can make this a little bit easier to see. That's not really blowing it up the way I would hope it would. In any case, this is the 130, 170. So equidistant, $20 up, $20 down. That also happens to be about 16 deltas if you're looking at regular way. You could collect $3.50 for that spread when I was looking at this about an hour or so before the close. So what you're looking at then is, we'll call it 3.5 over 150, 2.33% premium collection. With a $23.50 break even in each direction, which is about 15.7%. So if the stock can stay within a 15.7% swing higher or lower, the trade would see profits. Obviously, in the ideal case, it would stay within the actual strikes, which are $20. So that's 13.3% higher or lower. But I wanted to give some a multi-year, we were looking at a 5-year chart right here. I wanted to give some perspective just to show how steep this most recent pullback was. And in fact, maybe we can shorten this up. We'll just take a look at year to date and move this out like this. So this will give us, I'm going to put it like that, and we're going to go out to July. So again, I'll just create some lines on the chart so we can sort of see what we're talking about here. So roundabout, this doesn't have to be exact. I just want to give you guys just an approximate sense of what we're dealing with. So about 170, about 130, $3.50. You'd get short at 170, long at 130, like that. So, and the stock is right here. Something to think about. But the next question is, how bad do we think it could get? So to put that into some perspective, I usually show this summary table, but I think it's probably better in this particular instance if we actually take a look at the company's income statement and outline more specifically where the company is actually deriving its revenues. So it's about 72 or 3%. Here, let's go into Google services, subscriptions, advertising. So this is probably as good a way to look at it as any. So hopefully you guys can see this. This is the line that we are interested in. We're dealing with 70 to 75% of the company's revenues, are coming from this. So it's a concern if that's going to get hit. I don't have a really concrete view on this. I want to be clear. I thought that these concerns were a little bit overblown, to be honest. And, I will maintain that I think, we can't really account for trends of what people will do. Whether it's a good idea or not is another matter. So what I'm actually talking about, and this is where I sort of came up with this, the land of make-believe from Mr. Rogers' Neighborhood, and that is that the issue with these AI applications is that they invent stuff. Now, I'm sure many of you who are watching may remember that there was apparently a law firm that decided to use one of these, and they developed their case based on the responses that they got to certain queries. And it was brought up, and maybe we'll even be able to have somebody remind us what the case was. But it had a whole case laid out, and they cited precedents. And it was making up cases. I think it was ChatGPT that did this. So these kinds of hallucinations are a real thing, and they are more common. Now, the great utility, if these things are working properly, is that, if you have a certain question and you're trying to research that question, searching the internet, it basically ties the whole thing up in a bow for you. Helps you reach a conclusion, and in theory, cites or provides some sources that are going to be relevant. But that's only true if that stuff is legitimate. And the bigger issue that we have is that it is already a problem when we are going on the internet, as all will know, whether or not the information we have is, number one, accurate, and number two, is in some way representative or not deliberately misrepresenting whatever the topic is. When we search for something in Google, I'm not sure what it is or really that it matters. You come up with the top result, and then you can kind of qualify for yourself whether or not those sources are legitimate. But when you run a query on one of the AI applications, you get this full answer, and it may have some citations that you can thread to, and that's helpful. But you're dealing with the internet, which is already a vaguely difficult source to navigate and sift truth from fiction. And then you're using applications which are known to invent things. So my hope would be that before Apple decides to make such a choice and go in that direction, whatever people's taste may be, that they're going to try to emphasize the quality of the results you get, which, by the way, was one of the reasons why Alphabet, first Google, it was still called Google at the time, one of the reasons that they became so successful is because if you've used other search engines, you will have probably identified that theirs was the best, and by a pretty good margin, and consequently they got rewarded essentially with all the traffic. People weren't using anything else. If people are having a harder time sifting whether or not the results that you're getting are legitimate or not, I don't know. But I will say that I was quite confident about Alphabet before this. I am more concerned about it now. However, I do suspect it's probably going to be a little bit range-bound until we get to the next earnings. Okay, so then on to the FOMC. I don't think that this was a surprising result. What Jerome Powell said today essentially reiterated what he's been saying probably the last 5 times he's spoken at least, which is that there is some inflation risk associated with tariffs, but that they didn't see any reason to act now or act quickly. I actually think that's probably the correct course. The unfortunate reality of it is that if rate cuts are really needed, that's the kind of thing we always find out after the fact. But given that we had been on a fairly high inflationary track, I think that it is important for the Fed to be maybe a little bit more hawkish. So if they have to err in either direction, coming out of the highest inflation we had seen in 40 years, they have to be very sure that they're not going to reignite it. It is some recessionary impact is probably going to be better than jeopardizing the value of the dollar even further than it already has been. So that is that. Now, there is something else which I wanted to bring up because it was a question that was being asked on our last live stream. And it was Steve Garcia that had asked it. And I don't know if Steve Garcia is watching today. But one of the things, it was about Progressive. Steve had a position in Progressive. It has done remarkably well, outpaced his other investments, and consequently, the net effect of that is that it now represents a disproportionate percentage of Steve's portfolio. And I made the point that I like the insurance business, I like Progressive, so it's all good there. And that, in a vacuum, most pension managers will adjust their positions accordingly, and they will sell out of positions that have outperformed so significantly that they now have a disproportionate percentage of a portfolio, and then reallocate to other things. And there's a couple benefits to this. If something gets overbought, you end up selling off a little bit, and if you have other things that you like and they are temporarily depressed, you can dollar cost average in and buy them at more attractive prices. That's the good news. What I did not mention, and I feel compelled to do so, is that Steve Garcia also happened to mention in one of his posts, hello from sunny Marin. Marin County, that's where I happen to be. Well, if you're in Marin County and this is a taxable account, I got some bad news. And that is that this is a high tax state. The highest, actually, the marginal income tax rate in the state of California is the highest in the country. It's over 15% just on the state income tax side. And I mentioned income taxes. So for those of you who are saying, well, wouldn't you be dealing with capital gains taxes? Normally, yes. But California, unfortunately, doesn't really see it that way. So to them, income is income and what's yours is mine as far as the state's concerned. So they actually would charge this long, or they don't have a concept of long or short-term capital gains either. Now, don't come to me for tax advice. Go to your tax attorney, your accountant, or whomever. But one of the points I did want to make is that if that is your circumstance, that does throw a wrinkle into this from a portfolio management perspective, which is that what is ideal to do from a portfolio management perspective, if you're not accounting for taxes, can be very different than if you're accounting for it with it. And, my former boss, who also happens to live in California, has a substantial position in Netflix. He was confronting this very issue when he was contemplating hedging his position going into the most recent earnings. He was actually bullish. I sort of talked to him about things like the butterflies that we talked about here, how you might actually get a free look. You could, buy some downside butterflies for a nickel or a dime, get short the strike that would be less likely to get exercised, and then you could just exercise your puts if the stock really fell. And he didn't want to do it, even though, of course, having millions of dollars in Netflix stock, he didn't want to take a loss. in the event that the stock declined. But his basis was so low that the last thing he wanted to do was exercise a put option and face the potential tax consequence, which could be huge. So if you have a potential tax consequence that is 35% of the difference, if you have, say, a $250 basis in Netflix and it's trading $1,000, well, 35% of $750. I mean, that's how much you're potentially looking at in terms of the taxes. That's a lot. The stock has to fall a lot in that circumstance for you to be better off than you would have been just by taking the mark-to-market loss. So that was the thing I wanted to bring up about Progressive, because if I didn't mention it on the last stream, it occurred to me after the fact, and I thought, if you're in a high tax area, always contemplate the tax consequences, because it does have an impact. Okay, so Jeff Jr. Hey Mike. Hey to you. Hey Jeff. Thanks for joining us. Alex S. Hi Mike. Love to hear your take on this. Between selling a SPY one lot, 10-point wide spread, or two lots, 5 points wide, how do you analyze this as far as risk and reward? Oh yeah, that's a very good question. Interesting question in the case of SPY, because actually SPY being a well north of $500 instrument, so you don't talk specifically about how far out you're going, but the way to think about it is you have to think about the possibility or the probability of various outcomes taking place. Let's see if we can work through an example together. And then I may not use SPY because I might want to have something that has, where the strikes are more on a percentage basis, because SPY, here's the thing to think about, right? So, SPY is more than $500 a share. A $5 wide spread in SPY is less than 1% of the underlying. It's a de minimis move. Even $10 is less than 2%, right? So it's not a big move. So depending on how far out you're going. Now, if you're dealing with, say, zero DTEs, that's one thing, right? Because a 1% move in SPY over one day or a 2% move, there is a big difference. But if you're talking about over a month or two or a quarter, it's very, very different. But let's just take a look at how you can think about this and use this kind of information. So what you're interested in this case is the possibility or the probability that the underlying violates or trades to or through the first strike versus the likelihood that it trades to or through the second strike. Okay? So another way to think about this is that, and this is why I want to use a more extreme example, because if I use a more extreme example, it'll probably illustrate it a little bit better. So instead of using your example of $5 and $10, I'm going to use sort of argument ad absurdum for now, and we're going to actually ramp those up by an order of magnitude or two. Okay? So let's imagine that you were going to, say, sell a put spread. Let's just start with that. I don't know that the expiration really matters. Why don't we'll pick something 6 weeks out-ish, okay? Google doesn't really matter. I was looking at Google before, but why don't we start with SPY, and I'll just use wider strikes than you've selected. This will help everybody understand the concept of what I'm getting to, and then we can talk about what you're looking at more specifically, because I suspect that you're probably if you're dealing with spreads that wide, you're probably dealing with much shorter dated options than this. That's my guess. You can confirm that if you want to. But let's take a quick peek here. Okay, so we're in SPY. Let's imagine that you are going to sell a put spread. Okay, so you say to yourself, let's just switch these over to puts so that make it the same sort of thing. Okay, so we're going to say, well, let's say you sell the 560. I'm going to do first your $5 example, and then I'm going to do a much bigger one so we can kind of see what it is that I'm thinking about here. And then you do, say, the 555s. Okay, so that's your $5 put spread example. Selling the 560s, buying the 555s. I'll just use mid-market prices, but that's actually not the important thing for us to think about right now. What is important is, what are the chances that SPY falls below the 560 put by the time this option expires? Shorten this one up. So you can get that number by taking a look at the delta. Okay, so the delta of the option, which as we can see here, is 45. So that's the probability that that option is in the money at expiration. Okay? And the 555 puts, which you're buying, are a 40% probability. So it's 45% chance that it's at or below 560, and a 40% chance, oh, you updated. A better example, okay. Yeah, difference between a 1.20, 20 points wide and a 2-lot 10-point wide. Okay, yeah. So now this is where I wanted to use the example I'm going to provide, just so that we can kind of think about how the different ways to think about risk. Okay, so if you used this trade, right? What's the you do 2 of these? Well, the most that this trade can be worth is the spread can be worth is $5. You're going to do 2 of them. So if it blows through, that's 10, right? So I think this is where you were coming from. The thing is that my chances of that being worth 10 are 40%, right? It's 40% because that's the probability that the stock is at or below the 555 strike as of July expiration, right? So now if I did one 560, 550, well, 550 is, if I do just one of these, it can also only be worth $10. Now we can take a look at the difference in the spreads. So this one is 322. So 322 is the most you can make. 678 is the most you can lose. And the chances that you have experienced that max loss at expiration is 36%, because now I'm using the 550 strike, see? So max gain, 322, max loss, 678. Probability of max loss is going to be 1 minus, it's going to be this number right here, the lower strike, so 36% chance, right? And then you can also do some other math too if you wanted to. You say, okay, well, 322, so what's the if you can either model it to get the actual deltas, or maybe you're using something like this, it's dollar strike, so it's pretty easy. You could say, okay, I sell, what are the chances that I'm actually losing money? That it has to be below 557, 42%, right? So 58% that it's profitable at expiration, because it's going to be, there a narrow band where the underlying can be below the strike that I'm short, but above my break even, right? So this is, another way to think about it. Now let's just imagine, for the sake of argument, that I said, okay, I'm going to get really absurd, and I'm going to say, not the 550s, let's make it the 510s. So now we're going to do the absurd thing. So that's $50. $50 is the max value. So now I'm collecting $10.56 per trade. The max loss is $50, or 5,000, essentially, or the max value, I should say, is 5,000 for that whole spread, right? 560 minus 510 times 100. So 560 minus 510 is 50 times 100. That's how many shares there are per contract. So that's $5,000. So I'm basically collecting about 20% of the maximum value of the spread. But the chances that it gets down so that I lose all that money is now only 14%. Because, of course, the S&P has to fall quite sharply, right? It has to fall by 10%-ish, or a little bit more, actually, no, it's about 10%. So 10% to get down to that level. Not a highly likely event. So when you think about the risk reward, this is an important thing to think about, because it can get very deceptive. If you said to yourself, oh, well, I'm willing to risk $4,000 in potential losses, but I'm just going to do tighter strikes. Well, that doesn't really work, because the probability that you experience that max loss would become much, much higher if I did more of a narrower, closer to at the money strike, if that makes sense. I'm hoping it does to everybody. So it's what you want to know is not just what the max reward is, not just what the max loss is, but what the probabilities are that you have that maximum profit. The probability is of experiencing that max loss and everything in between. So, and I'm not going to get really into it because this is a more thoughtful conversation, and I actually will do this at some point. But a lot of margin rules are actually based on these sort of concepts, which is the probabilities of profit or loss and how much you expect to make or lose in various conditions. So, for example, the way the OCC would margin us as a clearing firm was based on this concept of an excess shortfall. So you think about a probability distribution and, overnight, how much money did the bank have to keep on reserve essentially to, basically ensure sufficient capital to meet any requirements associated with our positions as far as the OCC was concerned. Well, you take a look at that distribution and then you stress it and you say, okay, well, in the worst case, we'll say, the 5% confidence or something, which is both sides, so call it 2.5 to the downside. So if you end up in that bottom tail, there's a whole bunch of stuff that can happen in that bottom tail. Now, you might have tons and tons of positions, so you're basically stressing all of these things in different ways. What they would do is they would take the mean value of everything in that tail. So they say, all right, let's assume, you have all of these positions. Let's assume the bad thing happens and it swings, to that 2.5% probability realm. Not the 2.5% probability event, but that realm, 2.5% and everything beyond it. And then you average all of those potential outcomes together and you say, well, this is the average value of that tail event. And then they say, okay, well, that's how much the margin requirement for the clearing firm is. Whatever the average value of the disaster is, that's what your capital requirement, in a really simplified way, that's what the excess shortfall calculation in VAR is basically doing. And that's how you can do it. Again, but it doesn't have to be very complicated. Just think about the various probabilities and then go like that. So Alex V is saying the probability in that SPY spread that you're looking at should be below the break-even delta, not the lowest strike put delta. No. So look, the probability that you should be looking at is what is the chances that I'm going to lose everything? Or it's not a loss, because you could also be looking at this from the other perspective of buying this. You could be buying this and you could say, well, what's the chances? What is the options market's implied probability that the stock is at or below this put strike at expiration? And the answer is the delta of that strike. So the chances that SPY is at or below 510 by June 20th expiration is 14%, using delta as your approach for establishing that probability. And of course, this will be affected by time. This is one of the convenient things about using this as our back of the napkin technique for estimating these types of things. I can go out 2 weeks to the 9th, actually it's 9, I go out 2 weeks. So there we are, May 21st, 2 weeks from today. And that's going to be, the 510 is basically nothing. There's almost no chance. 5% on delta, and that's probably, it's going to be jacked by higher implied volatility. There's probably more volatility risk premium in that. There's a lot of kurtosis, a lot of negative skew. And if you shorten this up even more and say, okay, well, what about this week? I want to know what it is by the chances of the end of this week. So today is the 7th, so that's going to be the 9th. That's going to be a 0, right? And in fact, probably even a much higher number. Even to get to a 5% probability, we're looking at something like 543. So that's the way to think about it, sort of back of the napkin. So it is the max risk, max loss are not the only things to think about. It's the probability of respective events. that makes that matter a lot. So, and it's true for anything where leverage is concerned. So, if you levered, a simple way to think about it is you're just adding leverage. When you shorten those strikes together, you're essentially adding leverage for these near-term moves. And that makes sense too, because you're doubling the quantity. So you're basically saying, I want to make double over a shorter move if you're long, or I want to make double hoping that the move doesn't happen if you're short. But use delta to calculate your probabilities, and then you can think about where your break-evens are and things like that. I mean, you could use an application like this. It's going to tell you. It's going to give you your probability of profit. So that's already going and essentially telling you this is the break-even, 557, and this is the probability that it violates that. And most of your applications probably do something like that. Okay. NVIDIA, now that export restrictions are gone. What did Jensen say? Was it yesterday or the day before? I think it was some, pretty spectacular numbers that were being suggested. This is the thing that I would just offer people to think about. And that is that, for this kind of growth, and it's, the street's looking for slower growth. But, these are not outrageous numbers to be paying. So this is 2026 fiscal year, but that's really this year because their fiscal year runs to the end of January. So we've actually already experienced some of this. So, we're looking at, this will be on a trailing basis, assuming they get there. 51% growth. So obviously the stock has gotten a nice little bump here. I mean, I think I've said this before that, once it gets down to a certain point, you kind of feel like, all right, there's a lot of bad news priced in. And that's still 26 times, essentially, this fiscal year's full year numbers. Not that much more expensive than the S&P. Now, they face risk from something like quantum, for example. That's the thing that most people worry about. But, the stock, believe it or not, even at its all-time highs, if you thought that their forecasts and most of the street's forecasts for this were anywhere close to realistic, other than this pigs in a python thing, even at its highest levels, it wasn't obscenely expensive. Now, again, don't make the classic Wall Street analyst mistake where you just use a straight edge and say, oh, well, they've been growing at this rate, and whoosh, just draw it off to infinity. That's not realistic. But, if they got to 2026 numbers, and then simply grew at a steady pace along with the economy, that would still be a spectacular business to own. And, the only thing that concerns me is, can they preserve, right now they're the only game in town. I've never seen anything like this where, you've got a hardware company that's got 73% gross margins. It's got 64, 65% net margins after paying income taxes. I mean, that's just incredible with these kinds of growth rates. Can it go on forever? I mean, it can't. I mean, the laws of compounding would prevent it. I mean, they would... all money would flow to NVIDIA if this kept up for too long the way compounding works, so that's not sustainable. But I will say that, I think that, an allocation, most everybody has some exposure to it. Even if you just own the Qs or SPY, you have exposure to it, and that's probably enough. I'm not going to suggest that you add a whole lot more, because if you just own SPY, let's see what the allocation is. So right now, if you have SPY or the S&P, yeah, you've got, it's 6%. If that was all you had, that's 6% of your portfolio. And if you have the Qs, that's big enough. And if you have the Qs, it's 7.6%. So you don't need to own one of those ETFs and go out and own this stock. But if you do own it, I'm not going to tell you to sell it, because I don't like selling businesses that aren't obscenely expensive and are growing much, much faster than stocks, than publicly traded companies' earnings and revenues are otherwise. And of course, if you've owned it for some time, and there are many people that do, I have another friend who owns NVIDIA. He almost by accident opened an account. I can't remember where he said it was, like E-Trade or something, and put some nominal amount of money in there. And it was such a small amount of money that it made a big portfolio. Apparently, I'm having some slight audio problems. Hopefully that resolves shortly. Forgot all about the account. What did he buy? Bought NVIDIA. And like, account. What did I don't remember that. What's in there? Yeah. Hundreds of thousands worth of NVIDIA. And, you know, again, he's also a California resident. So what are you going to do? You're going to take the huge tax hit, or are you just going to hope that the company continues to perform? Because that was not a tax-deferred account. So there you go. All right. So I hope that answers the SPY question. If it didn't, on the spreads issue, if it didn't, then people can also, you know, maybe we can get into that a little bit more. But I might want to try to come up with some slides to sort of go into that. Good morning, Mike. When you have a chance, this is Finn West, can you show where one can find the expected moves for upcoming options for any given stock? Thanks. Well, here's the beauty of this. The expected move will, for any period, will essentially correspond to the value of the at-the-money straddle for that expiration. So doesn't matter whether there's an event or not. And actually, to illustrate this could be interesting. I think it would be interesting. So let's take a look. Well, I should use let me use unusual whales for this 'cause it's a little easier. So we'll go over here and let's take a peek. So what we're going to do is we will go to, what do I want to look at here? So what I'm actually trying to do is find something that does not have an event, but then does have an event. So let's just go over to flow. Let's do this. All right. So we're going to take a look at let's just take a look at the calendar and let's look at earnings and let's find something that is going to have earnings when we'll get something that's late. Hopefully has weekly some weekly options, but so let's look for something that's going to report earnings not this week, not next week. That's right. But thereafter. There's a name I like. BJ Wholesale. I've talked about that with you guys. Actually, I was just looking at this the other day because I'm pretty sure I talked about this on the live stream. In fact, I know I did. I know I wrote an article about it. It was back in November and how I liked BJ Wholesale better than I like Costco. And yeah, it's up 50%, I think, since then, since we talked about it. And it's outperformed, Costco's also higher, but it's outperformed Costco by close to 40, or it had as of the last time I looked at it. So let me just double check this. But this will be a good name for us to look at. Well, actually, it might not because I don't know if they have enough options trading. We'll probably look at Costco too. But I figured I would bring this up because I happened to be glancing at it yesterday, and just to see how the trade was doing. And I thought it was kind of interesting. Oops, don't hit that button too fast. Not keeping up. All right, so I'm going to wait 1 second, see what you guys see, because sometimes this doesn't keep up. And let me normalize this. And let me go back to November. Can probably look it up. If you just Google my name and BJ Wholesale, you'll probably see the date that I published it, because it was also I think after we talked about it on the live stream, I think I also published an article on the CNBC Pro website and on the Options Edge website, also about the same topic. So not up quite as much now as it was then. 40% versus 9.5%. So this bottom chart here is the relative performance, the outperformance. So try to look for companies that are in the same space, service the same clientele and in a similar manner. The big difference here is that BJ's is regional and Costco is obviously much bigger. BJ's doesn't admittedly grow quite as fast, but it's trading a whole lot cheaper. And really the only reason I started to take a look at it is because I thought, God, Costco has such a great model, but at 50, 60 times earnings, I just cannot do it. Can't do it. We don't have BJs near us, so it was not a highly indexed name. But yeah, okay. So now, well, let's take a look at this. So let's see, let's take a look at events where we've got some earnings. So Costco, I'm going to use Costco. I was going to use BJ because that's what came up on Unusual Whales, but I'm going to use Costco because Costco has more active options. And because it has more active options, it'll be easier to illustrate this. Okay, so what do we know? We know that they're going to be reporting on the 29th. We know, therefore, that the options that expire at the end of this week don't capture that event. The ones that expire at the end of next week don't capture that event, and so on. Okay, so it's not until you look all the way out until these May 30th options. Okay, stock's about $1,000. We'll use 1,005. So you can see the expected move, which is different than the standard deviation. So the standard deviation is one statistical measure. What we call the expected move is also a statistical measure, but it's actually referring to the mean absolute deviation. And for a normal distribution, and I've mentioned this more than once, the mean absolute deviation is simply the standard deviation times the square root of 2 divided by pi, which is 0.8 in round numbers. You know, I like to use round numbers because, you know, all of these things we're dealing with various degrees of uncertainty. That's the kind of, you know, minute difference. It's not going to make a difference. Okay, so you could just take the at-the-money straddle, which in this case, the closest one is going to be the 105s, and you could just add the value of these two options together. So we'll call it $18 or so for the 1,005 calls. We'll call it $14 for the 105 puts. That gets us to $32. Okay, so $32, pretty easy, give or take 3.2%. But now if we expand out to here, let's take a look. So that's those options, the ones I just gave you, are 9 days away. Actually, let's go to these ones here. We'll go out to the 16 days away. So 16 days away, 2 weeks-ish, and you'll see why I'm going to move out to this 2 weeks-ish in a second. Actually, hang on. Yeah, so 2 weeks-ish. We're looking at, we'll call it 23.5 for the calls. Now, these are almost certainly trading a little tighter in the regular session. Spreads tend to widen out, but the midpoint's probably not a bad approximation. $18.5, right? Something like that. Yeah, we'll say that. So now we're up to $41.5 on the straddle-ish, 4.12%. But now let's take a look at the Mays, the May 30th. Why are these important? Well, these ones also happen to capture the earnings event. So now we're up to $60-ish, right? Yeah, it's about $60 for that one. 6%. So if you want to know the expected move, you can, a quick and dirty way to get that, in almost anything that has any options information, all you need to see are the options prices, is to go find an expiration, see what the straddle is that expires close to that, and that's roughly your expected move for that between now and that time. That's the mean absolute deviation, folks. That's the sort of statistical term for it. Okay, James Warren, was Apple paying Google? So look, I mean, how does Google make money? It's when people use their search engines. So every single time someone's using Safari, then you're getting, and it's flowing to Google, then that's money in their pocket. So if they direct it elsewhere, that's money that's not in their pocket, and it's over 70% of the company's revenues. And Apple is big, right? People use their mobile devices. Here's a way to think about it. 40% of mobile devices in the U.S., is it, are Apple? It might be higher than that, or it's I don't remember what the latest numbers are. Probably is higher. You don't want that traffic going someplace else. And actually, here's another thing which shows how important that is. So everybody's sitting here saying, oh, how are they ever going to monetize AI and all this other kind of stuff? Does it justify the CapEx? Well, you tell me. I mean, look at, you're talking about $238 billion worth of revenues for Alphabet in full year 2024, I think. Or was that 2023? I'm going by memory. That even seems light now that I think about it. So that it's actually got to be bigger than that. That's a huge revenue stream to be going after. And if a large language model starts attracting that traffic instead, it's totally disruptive to the industry. So it's absolutely huge. Okay. Okay, so let's see here. Could you please share your thoughts on Walmart earnings next week? Selling the 105 call vertical for a net credit of $2. Okay. Walmart, my thoughts on Walmart. Not crazy about the valuation. I like what the company's doing. I think they're doing a great job operating the business. But it's not a huge grower, first of all. And I'm a little bit flummoxed by this, right? So we'll round number it. Say it's a $100 stock, that they're going to make $3 next year. Okay. 33 times forward earnings for something that's growing the top line at 3.5%, 4.5%. Oh, I don't know. It seems kind of pricey to me, especially when you compare it to Amazon, which was trading cheaper. It was trading 25 or 6. Let's see, where is it now? And they're taking market share, right? So Amazon is taking market share from Walmart. They have cloud, AWS. So this one is trading, so that's $8. I can't really compare the 8 because remember the fiscal year for the other one was January. So it's going to be somewhere between, call it $6.80 and $8. Let's call it $7.25 a share. So, and I'm going to round up. So 200, 725, 27.5 times earnings instead of 33, growing the top line faster, and taking market share, all because Walmart sells groceries. They're a great operator, but I don't know that I'd pay 33. So that's my thinking on Walmart, okay? Second thing, going into earnings and stuff like that for a lot of these companies. And I should probably pull it up because it's always nice to be able to visualize it. So we're just going to go in here. We're going to go to earnings. We're going to throw in Walmart so we can see what the implied moves were, how big the actual moves were. All right. So this is the one tricky bit. You can see that the implied move right now, 4.8%. That's bigger than the historical implied moves. Not surprising that we see it. Why is that? That's because the market hadn't really been expecting very big moves for Walmart. And we got a few, right? So this one exceeded, that exceeded. These are all kind of in the middle. That exceeded by a lot. This was at the outer end of the range. These exceeded by a good amount. This one was towards the outer end of the range. That one exceeded by a decent amount. So, not surprising to see the options markets pricing in a little bit more movement this time around. But this is kind of a nice visualization. I like this. So this dotted line represents the average price action for Walmart to and through earnings. So this vertical line right here, if you can make it out, that's the earnings date. We're still before it. And this one's tracking, looking a similar number of days before to a similar number of days after. You can see that Walmart, at this point, after having initially underperformed that price trajectory, and that's not a prediction. It's a melange, a combination of an average of all of the prior experiences over the last. It says 12, it's really 11 because the 12th quarter is the one we're in. And of course, we're not to the finish line yet. But it is outperforming. So on average, 11 quarters up a little over 3%. Going into the print, outperforming by about 4.2%. So my thinking is I'm a better seller of Walmart. The stock's done pretty well going into the numbers. The only thing I would say, and I'm sure you guys have heard me say it, is that I'm not crazy about just selling calls or things like that going into a number. I'd rather do something like a calendar spread or something like that. So that's the only downside I see. And we're going to put your actual trade into this so that we can see how much you said $2. So it's 40% of the distance between the strikes. That's not bad. Actually, on average, the stock hasn't done that well in the first 2 days thereafter. So, you would almost certainly get an opportunity if it did something similar to trade for a credit. So, other than that one proviso, which is I would rather sell premium, a slightly lower premium between events than a slightly higher one through an event, because about 40% of a stock's moves probably come when they're reporting quarterly earnings. Rather not, because it's a coin toss then. It's one thing to say, oh, I think we're butting up against resistance, or the stock is fully valued, or I think the market's kind of a little exhausted here, so I want to sell some upside call spreads. It's another to say, there's going to be an event, it's on this day, and it's going to make or break. Because now you're dealing with a little bit more of a coin toss, and you can see it's had some decent sized moves. But other than that, I like the trade for those reasons, and prefer Amazon on the long side. I mean, I've said it. I'm sure you guys are getting tired of hearing me say it. That's one thing about me, and that is that it's not that I can't change my tune. I'm kind of trying to get my arms around Alphabet. I will change my opinion, but in the case of Amazon and Walmart, I haven't seen anything that's making me change it yet. That Amazon's a better do than Walmart. And BJ, despite the big rally, probably still a better do than Costco, although not nearly as good as it was, because as you can see, it's outperformed huge since we mentioned it first. But if you guys have that trade on still, or you're thinking about it, okay. Let's see. Eileen, does Bloomberg show what percentage of advertising dollars come from YouTube versus search? So, first things first. Bloomberg is a data aggregation tool. They do have some proprietary stuff in here, but this isn't necessarily information that you can't get elsewhere, because there's two things going on here. They scrape what the companies and others put out. So it just gets all that data and then drops it here. Now, so just so that we can look at it in the same format every time, they have sort of some simplifying assumptions that they do. Let me show you what I mean. So if you look at the income statement, you're going to see a couple different buttons up here. So BBG adjusted, which is Bloomberg adjusted, BBG GAAP, which is Bloomberg GAAP, which is generally accepted accounting principles, and then as reported. So if you take a look at the company's income statement, these are the numbers. These are the numbers that you would be seeing. So this is the stuff that's going to tie out if you go to the Investors Relations website and you look at the corresponding data that they released. This is what it's going to tie out to. These other figures are essentially, they scrape all of this data, but if all they did was just show you the same whatever the company put out, it makes it harder to compare one company to another. So you have to make some assumptions, then you kind of shoehorn that information into categories, and then you can just map those categories against other similar related businesses. So actually, we're going to find out right now what they offer in terms. So here in this segment section, this is what I have access to. And now, with respect to search and YouTube, you can see that the YouTube ads are 10.3%, and search, this is as of the most recently reported full year, was 56.6%. Now I'm going to make an adjustment. These numbers might disappear, by the way, because I'm sure you guys have seen this. You listen to every quarterly call. You read every quarterly earnings report, and then oftentimes companies will have metrics. We're about to find out whether that's true here. They have metrics that they report on an annual basis, but that they do not report on a quarterly basis. And so now I just switch this to quarters. And we'll take a look. So this is for the most recently reported quarter. And we can see here that it was 50.7 billion from search and 8.9 from YouTube. I can't remember what they paid for YouTube, but I mean, I remember at the time thinking, boy, that seems like a lot. And now I think about it, what they've managed to turn it into, and I think, boy, did they get a great deal. So, talking about changing one's opinions. So that's, 5.7 times. 5.7 times as much revenue in the most recently reported quarter came from Google search versus YouTube, to answer your question. But you can get that too. It'll be, so like I said, this is an aggregation tool. So just because I'm able to find it pretty easily doesn't mean you can't find it as well by going to the company's investor relations website. It's just probably going to be a little bit more clunky. But what I usually like to do is I will go to the investor relations website. So, and then I will find their most recent annual report, and then I just use these little buttons up here and just search once I'm in the PDF to get right to it. Now, sometimes they have presentations. Let's see if you'll see if they happen to have one. Annual filings are a good place to get general information. Like I said, some companies will report more and not less. Then you just go in, you find the most recent release. Oh, they've got slides. So that's nice. And then you just go in here and do a. I mean, look, you guys can do this just fine. I'm just telling you, how I would do it. And then you just put in whatever you wanted to find out, YouTube, and then you can go right over here. And where does it take you? Right to a slide. Right. So I just showed you how you can get it on a Bloomberg terminal if you happen to have that. I just showed you how you can get it from Alphabet's own investor relations website, which everybody has access to. So I should do that more often. I don't have to pay for the Bloomberg. But muscle memory, all that. Okay. So, Take-Two perform after earnings historically. All right. Well, so this is one of the things I will say. I wish. Let's see where we got here. I'm in the wrong section. Where did I put my unusual whales? Where's unusual whales? Oh, here we are. This is something that Bloomberg doesn't do. So frankly, these guys just do it better. I like because they give you the numbers and they give you a visualization of both historical and historical implied, which I can get out of Bloomberg, but I had to write my own spreadsheet to do it. So this is Take-Two, and this is the historical price action. These are the historical implied moves. These are the historical actual moves that took place. And this is where we are relative to that same history. And because you asked the question, and I'm assuming that you don't have unusual whales or you wouldn't be asking it, I'll leave this on the screen for just a moment so you can get a good look at it. But if you don't have unusual whales and you think about getting it, I'm pretty sure we have an affiliate link and you get some kind of a discount. Someone's going to get in my ear and tell me what that is. 20%? So they don't remember either. But you get a discount. So if you like what you see and you want to get at a discount, there's an affiliate link, I think, in the description for this video, and you can get it. And then you just go, when you want to look at those things, you just go to Ticker Explorer. It's kind of handy, right? So you can actually go in here and it's on Take-Two, but you can go through different charting applications. This is a really helpful one too. its volatility. And if there's anything that you were thinking, oh, I'm kind of curious, like how much skew does it have? How's implied versus historical, which is a little bit more nuanced way to look at it than just taking a look at the earnings moves over the last several years. You can get that kind of information here. You can get analyst ratings. You can see the options change. This, I think, is a nice visualization tool as well. It gives you the analyst price targets, who gave them, how these things have changed, and where they are relative to the stock price, all pretty handily done that way. This is also really helpful, and that is the insider transactions, because this part over here, they have a code. And what you can do with the code is, so first of all, it tells you who they are and why it matters. I'm going to just show you by comparison. I think so. I'm going to pull this up on a separate screen so we can look at it here. One of the things you can tell, which I think is helpful, is, are they making purchases or sales, or are they just simply exercising options that they were previously granted and then dumping the stock? Now, some of that's okay. For a lot of these people, they either get restricted stock units or they get options in the underlying, and they convert those with, on some regularly scheduled sort of metronomic way. Every quarter they exercise a certain amount, and, that's part of their financial planning or something. They might say something like that. But the nice thing is that you get all that information right here. I find that to be pretty helpful. And then, again, if you don't want to go to the investor relations website and you just say, oh, I'd like to see, this is also a data aggregation tool. It also is going to show you what the earnings per share are, all the same stuff I was showing you in the Bloomberg terminal in a very visual way. And it costs a lot less, like $3,000 a month less, which is a lot. 3,000. It's not quite that. Once you factor in market data, it's going to be 3,000. It's probably more like, what is it, Bloomberg? I just paid a bill. $2,600 a month, plus tax, depending on wherever you are. Okay. Let's see. After Uber's quarterly earnings release miss on the top line, thoughts on LYFT for tomorrow? Have May 16th in the money, at the money, and out of the money long calls. Hold, close, or roll. May 16th. So those are all expiring regular way tomorrow. Well, what did I just do? I shouldn't have taken that down. Oh, sorry. So do I think I guess the first question is, do we believe there's any read-through? And I think there certainly is some. I haven't, I think it's important to listen to the full call and see what is going on exactly. Which parts of their businesses map more closely and which ones less. Obviously the strict rideshare, I kind of think of that as one for one. Same business, same demo, similar locations, like Sprint versus Verizon. Uber Eats, a little bit different, so you have to start looking into it and see how much of it is in that. Obviously, that can be a potential issue as well. The other thing I would say is that as we look at earnings right now, the expected move is about 12%. And you will notice, I don't know if you can see this, I hope you can, but you're going to notice that the implied move is actually relatively modest compared to how much it has historically implied, right? So here's an implied move. That was 16%. That was 16%. This was 16. And the last one was actually 14.4. And now it's implying 12. So options are actually relatively, a 12% move is obviously a very big move. But this one deserves it, because you can see that as big as the implied moves were historically, the options were worth the price. And, whether it went up or down, you were better off owning options most of the time as your way to play it. Two things I would suggest. One possibility is you could, you can roll out, but don't forget that if you roll out just a little, you could be trading, you're trading your gamma and you're going to get some vol crush, which is a problem. So you're going to see volatility get sucked out afterwards. We don't like that a whole lot. So that's definitely something to be aware of. This number right here, you see what we're looking at? This is a prior event. So now you get a sense of, what happens to vol. It goes up going into the event and then it comes down quite significantly. So that's a little bit of a problem that you would face if you go longer dated. This is probably a better way to look at it. So you see these, I'm going to get rid of the stock price for a second. So we're just looking now at the implied versus the realized. So what's going to happen to those longer dated options is what happened to purple here. Purple is the implied. So you go into the event, and then as soon as the event happens, bang, down she comes. So that's the vol crush that you're looking at. And you are going to see some vol crush if you go farther out in time. So if you are trying to go, really extend, that's when I start trying to look into other potential catalysts so that I have less of that vol crush effect, because now you need the direction to be more right, not less. So if your thesis is simply to be bullish going into earnings, options, as expensive as they are reasonably priced for that, and you own gamma. You don't own vega. And that's good. Okay. The only tricky bit is that you also have a lot of delta, which is the stock-like risk that you're taking, because you said you have in-the-money calls. I don't know how far in the money you have them, but that is a consideration. You might want to think about, just bumping, rolling up a little bit so that you still have some of that convexity. If you take an in-the-money option and you choose an at-the-money one, you are going to have a little bit more extrinsic premium to accommodate, but you're going to have less delta risk. But I think it's fine, and it sounds, if you're laddered, you've probably given this some thought. I think it's fine to own options. I don't think they're outrageously priced given the moves that we've seen, as I've just illustrated. Okay. Oh, and you said roll to 3 or 4 months out. Yeah. So that's the thing. You would want to roll out past the next anticipated earnings for LYFT, beyond this one at least. And that is going to take you out to, this is just an estimate, August 7th. So, August regular way should be far enough if you decide to do that. And you'll notice that I like to do things like strangle swaps and stuff like that sometimes. Not encouraging people to do that here because it looks like a 12% implied move is reasonable in this thing. So I'm not crazy about selling premium going into that. Seems like a good, again, very reasonably priced given the historical moves we've seen. Okay. I lost my spot. But let me see here. Oh, there we are. Tucker D Dog says Google acquired YouTube for $1.65 billion. $1.65 billion, and it had $9 billion almost of advertising revenue last quarter. Wow. Yeah. I remember at the time, like, this is nothing, and people make their own videos. Why is that worth a couple $1 billion? Well, that's why they run Alphabet, and I don't. They clearly saw it. All right, so MSTY, pretty interesting ETF. So did I get that up on that? Yeah, MSTY, interesting ETF. Income by selling options on MSTR. Yeah. So, I would always rather manage the options position myself, but I can completely understand why, folks who like the idea of the strategy would rather just buy an ETF or an ETP that does it systematically. It's a maintenance issue to do it yourself. Maybe it's a margin issue. You buy an ETF like that, you can put it into tax deferred accounts, trades like a stock. So that's one of the things about these strategies. So that's the important thing to think about. Obviously I wouldn't do it in a non-tax deferred account myself because I'm an options trader, right? So I don't need other people to trade my options for me. I don't even know who they have doing it. So why am I assuming that they're going to be better at it than I am? But there are contexts actually where it does make sense. So one of those contexts is in tax deferred accounts where you actually can't trade some of these strategies as easily. Sometimes you're ineligible. So then you just buy something that trades like a stock, throw it in there, and you essentially get that risk reward return profile. And then also you don't have the tax issue. So the transactions will pass through. So I think it is interesting. Notably, by looking at their holdings, some of them are flex options. I guess those are traded OTC. So, all right, flex options, this is a good question. All of you guys can trade flex options if you wish. Flex options are not the same things as OTC options. I have traded both on both the buy side and the sell side. A flex option is actually an exchange-listed option, but it is bespoke. And where would the utility of something like... So the nice thing is it's exchange-traded. The nice thing is that you do not have a bilateral sort of counterparty-to-counterparty derivatives transaction. So OTC options, that means that you're facing off against the other party. So, and this would not, it's not a retail thing, totally institutional. For most customer side transactions, so non-bank-to-bank transactions, when you're trading OTC options, you have to have something called an ISDA. An ISDA essentially is it's an agreement between two institutions for derivatives transactions that they make with each other. And there's some structure to it. It's like a credit check, if you will. You want to trade swaps, you want to trade variance swaps, you want to trade OTCs, SPX options, doesn't matter. It's basically, we know each other, we trust each other, and then you're only taking on that other person as the counterparty, which can be a bad thing, because if that counterparty was Lehman Brothers, when they blew up, you lose. You have no recourse. Contrast that with exchange-listed options, which is what we usually talk about. In exchange-listed, and we used to trade a lot of variance swaps primarily. So that was the OTC OTC derivatives that we traded the most of. And those trade like water. I mean, it's just a really common thing. But it was mostly bank-to-bank anyway. The nice thing about flex options, you can customize the strike. You can customize the expiration. That's less important now because we have dollar strikes and weekly expirations. But that's a benefit. More importantly, though, you can decide whether the options are American or European. The distinction is American options can be exercised at any time. European options can only be exercised on the expiration date. And you might think to yourself, well, isn't American better than European? Not always. There are reasons if you are short an option and you don't ever want to have the risk of being assigned, this would be an important thing. Who's making markets on those flexes? Well, I used to make markets on flexes. I would either ask other people to make a market in them for me, and I have made a market in flexes. So someone just calls me up and says, hey, I want to trade 1,053.37 strike calls, European style, that expire on the 9th of some month. Okay, here's my price. So you look at the vols and you establish a fair price and you make it and you put them on the tape. And you can dig those out if you want to. From a market maker's perspective, they're nice. Why would a market maker want to make a market in that? Well, think about it this way. I am now a natural counterparty to the person on the other side of that. So they are fungible, meaning that they could come back down and they could get somebody else to make a market, but no one's going to have the same accent that I have. So, of course, I'm probably more likely to make a better price. The other thing is I'm going to get a look. So this is, as somebody who makes a price, I'm not a market maker anymore, but when you're a dealer and you wear all this inventory on your book, the thing that nothing will make you more upset than to make a big price. You're wearing this huge position. You got the thing on for weeks, maybe months, and all of a sudden you see it trade away. Somebody else, because the customer doesn't care who takes it off their sheets. So they go to the market and it trades away, and now you're still wearing it. And the only way you're going to get this thing off your sheets is to go find the other guy who now has the axe on the opposite side of you. That's how the interdealer market works. You know, that's when you banks trade with other banks through the interdealer market. So the advantage of a flex is that you're probably going to get a look because you're not, you know, it's going to follow the same chain back to you. So there's a better chance that you're going to basically get into it and out of it, if that makes any sense. So there's a lot of reasons why people would like to trade flexes, and we have done it. Usually do it in deal situations. So when there's synthetic options in a deal, flexes can be really handy because you can map the listed contract very closely to the embedded optionality in a deal. Really good example was when American Airlines filed for bankruptcy. They ended up merging with, essentially acquired by, US Air. And we were active in that deal. There was some embedded optionality due to the debt structure of American Airlines. So there was a whole bunch of options that were sort of basically built into NewCo. So if you own American Airlines shares, I'll tell the story as quickly as I can. Won't get too far into the weeds. Company filed for bankruptcy. It was operating in bankruptcy, but it didn't trade to zero. They decided they were going to merge with US Air. American Airlines had a holding company and an operating company. And they had what were called single dip and double dip claims, which means that people who loaned money to the business, either the operating company was the ultimate guarantor of that debt, or the holding company was the ultimate guarantor of that debt, or both. So if only one or the other was, that's a single dip claim. If both were, that's a double dip claim. So you think about the capital structure of a business, and you have all these people who have claims on the value of this business that is now operating in bankruptcy. All of these various tranches of debt, and whether they, you know, all the stuff that's going on. And at the bottom of the pile are people who own stock. You're the last guy to get paid. But they had to vote on the deal. So basically, the acquirers and the management made a proposal to the American Airlines shareholders so that they would vote for the deal. And they just said, look, if we pay off all of these claims, we'll pay it off with stock. Whatever is left over, you guys can have it, right? Now, we didn't know what US Air was going to be in the future, so you have to think about the different things that could happen. But everybody basically said, okay, fine, we're going to do that. And what that meant was that American Airlines shares were really they were kind of an option of sorts, because the way they were going to satisfy whether those claims got paid is they had these measuring periods. I think there were 4 of them, if I remember correctly. And they would say, okay, as of this date, we're going to carve out 25% of the deal, and you're going to look at the average price of the stock during that period. And then they would get a certain amount of stock, and that would satisfy those debts. And then another period, average price of the stock over a period, then they would get that much stock. And you'd basically wash out all of the debt with equity in NewCo. Well, what does that mean? Well, what that means is that there was that amount, that strike, well, it wasn't a strike, but that calculation value was essentially a strike. If the stock was really high, then it wouldn't take as much of it to satisfy all of that debt. And what was left over went to who? Went to the shareholders, AMR. So they effectively owned a call option on US Air NewCo stock. And so we figured out what the value of that was. And then I said, okay, well, I'm going to buy American Airlines stock, which has this embedded option, and I'm going to sell options on US Air. But the thing is, you didn't want to do that too much because US Air was now collateral against all this debt. So I wasn't the only one thinking of it. People are buying up the debt and saying, well, I'm going to buy the debt and then short the stock. So whenever I think the stock's going to, So you had a lot of people shorting the stock, became hard to borrow. If you use European options, they can't call you out of it. That's the magic. So that's why flex options matter. Things that you don't think about, suddenly they matter a lot. That little feature that you can exercise a call option early has a really important implication if you know that you have something that you have to wear for a long time. I needed to wear the AMR shares until the deal closed, and I didn't want to get called out of a position on US Air stock by being short call options on it. So anyway, flexes are very handy. You can trade them. You probably don't need to, but there's good reasons for it. Okay, I've been running way too long, and I just went on a long tangent about a deal that happened 10 years ago. You guys should look it up, though. It's kind of an interesting transaction. American did really well. I should never have sold those calls, by the way. I should have just bought American Airlines stock. I think it went up like 17-fold. Anyway, that's the scoop for today from Mr. Rogers' neighborhood of make-believe on the chat GPTs and Grok's made-up stuff. If you use that for search instead, be careful. You're going to spend as much time researching the topics. And be sure to tune in next week, not on Friday, because Mark Guthner's not around. He's on a trip, so he won't be able to join us on Friday. I might do one on my own. But until then, thanks for watching.